This is the CRE Weekly Digest by LightBox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Dianne Crocker. I'm here with Manus Clancy. Our trusty moderator, Alyssa Lewis, can't be here today, so Manus and I are flying solo. Manus, let's dive right in. We're here recording. It is the last day of April, believe it or not. The end of the first month of Q2. Yesterday was Fed Wednesday. Manus, what jumped out at you this week on the macro front?
There were a lot of moving pieces this week, and many of them were confounding. On the negative side, there were several headlines that we saw. The first, of course, the 10-year Treasury continues to glide higher. This morning, it was sitting at 440 as we record. Certainly not moving in the direction we want. It's moving, upwards and away from that 395 number that we saw before the war in Iran. Today marks the end of 2 months of the war going on and no immediate signs of this ending. I think it will end sometime fairly soon, but it's not imminent. Oil prices hit $120 a barrel yesterday, the highest price since the start of the war. OpenAI registered concerns that perhaps all this money that they're spending on data centers and chips may never be recoverable. They are on the hook for $1.5 trillion in spend over the next couple of years. And investors are starting to wonder if they'll ever see a return on that AI that surpasses that number and gives them a positive ROI. So a lot of concerns out there, but we saw some positive stories too. The consumer confidence number from the conference board surprised to the upside. This too was a little confounding in the sense that this was the second straight month that the conference board had beat expectations, yet the other major consumer confidence reading, the University of Michigan a few weeks ago, posted a really disappointing number. So numbers there going in two different directions. And yet, with all this noise, with all this confusion out there, U.S. equities continue to hover near all-time highs. Tech stocks announced earnings this week. They were better than expected, but they also raised their expectations for their CapEx spend. And yet here we are almost in bubble territory with U.S. equities. So it's hard to get my arms around it, Dianne, I have to say.
It is. It feels like kind of a weird moment in the market right now because nothing lines up clearly. You outlined a lot of reasons for that just now. The 10-year pushed up, as you said, to around 440 this week. And that move started even before the Fed said anything after yesterday's meeting. So the bond market is already telling you that financial conditions are tightening. They're not easing. You mentioned the consumer sentiment being split, which was really confounding. The conference board's data saying people feel okay about jobs, but then the Michigan survey we talked about last week showed that consumers are starting to feel a little bit stressed, especially about higher prices and paying more at the pump. On that front, it was a really weird divergence, but could just mean the consumer's still spending, but maybe they're not feeling great about it. As for yesterday's Fed meeting, clearly it wasn't dramatic. To me, it felt a little like Groundhog Day. The messaging, growth is okay, inflation is sticky, geopolitics are making the outlook messier. I did see that there were 4 dissents in the Fed decision yesterday, and that was the more dissents that they've had since 1992. Which for perspective is when I was in college. So there's no clear consensus on the path forward for rates either. But I don't know. I as I've been thinking about it and preparing for today, Manus, what does it all mean? I feel like it's what we've been talking about here. The market is getting a little comfortable with a lot of uncertainty all at the same time. But I talked to folks on the road last week. Folks are still moving forward with loans and commercial real estate investment. So that's good. I put faith in the numbers and what they're showing. And certainly we're still seeing things moving. It is the end of April, so we'll have April data within a matter of days. And maybe at some point, softer sentiment does show up in the numbers, but it hasn't yet.
Of the headlines we saw this week, the two that concerned me the most, one was the OpenAI, and that people are starting to question whether there'll ever be a meaningful return on equity for the amount of spending that's going on. And paired with that, and I've mentioned this already, several of the Magnificent Seven announced earnings, and seemingly universally, they pushed up their spending forecasts dramatically. And what this is doing is it's putting a real floor, if not a supercharge, behind certain stocks, chip stocks, data center stocks, et cetera. And you've seen shares of companies like SanDisk Micron, AMD, just reach ludicrous levels in recent weeks. And you wonder how quickly the narrative could change. And if the narrative switches back to AI from let's go AI, and we've seen a few inflection points since last summer, you could see a lot of these gains erased. And if the markets retrace where they were a month ago, down 10% from where they are today, you may see some of this enthusiasm bleed out. And that's the biggest concern for me, that the markets are really being supported by a narrative that is still spanking brand new. This AI narrative of it changing the world is less than a year old. And there's a lot of assumptions baked in here. And if there's anything that concerns me the most, it would be that euphoria we're seeing right now.
Yeah, and it almost seems like the headlines point to this being AI's first reality check. Chapter 1 was everybody piling in, throwing hundreds of billions of dollars in. Chapter 2 is people starting to ask tougher questions. It's the market moving maybe from hype to discipline. And it doesn't necessarily mean investors won't make money. Maybe returns take longer. Maybe margins are thinner. I think the risk is, especially from the commercial real estate side, is that expectations may need to scale back. If folks are underwriting these projects expecting these kind of quick venture style exits, then maybe it doesn't play out. If expectations cool too much and folks get really nervous, then sure, the epic pace of growth that we've been seeing could slow. We might see hyperscalers pull back a bit, or projects get delayed, or maybe scaled differently or right-sized. But I'll tell you, Manus, I saw a headline in the Wall Street Journal that caught my eye this week that points to a project going full on forward. And it was, do you watch Shark Tank, Manus?
I used to watch it a lot more during COVID, but yes, I am a casual viewer of Shark Tank. I like the franchise.
Same. Yeah, I've seen it kind of sporadically. I'm not a loyal watcher. But anyway, so the show's very own Mr. Wonderful, Kevin O'Leary, he's planning one of America's biggest data centers. It was in the Wall Street Journal, an article by Will Parker. So he's with a group of partners in Utah. They're looking to build a 40,000-acre project, equal to more than 20% of all U.S. data capacity. And we've talked on the pod about the huge demand that these massive data center projects require in terms of energy. They're bringing their own power by connecting it to Utah's natural gas pipelines. So they wouldn't even use the local grid. So moving in big on data centers there.
I wonder if this is a bit of a contrarian signal. You see these signals over time that when something shows up on the old Time magazine, it's getting tired, right? If Time magazine or Newsweek back in the day would say, now is the time to jump into U.S. equities, that was a negative signal, right? That we were at the point where if they were getting involved and they were starting to say something like that, then the party was approaching its end. You've heard things like this before, these negative signals. In the run-up to the Great Depression, there's that famous story, who knows if it's true or not, maybe it's urban legend, where Joseph Kennedy gets a tip from the shoeshine boy for a stock. And when the shoeshine boy is giving you a stock tip, it's a sign that, we're at peak euphoria. And the reason I say this with Kevin O'Leary, I have nothing against him for sure, is that he's probably not a data center guy, right? He's investing in companies that block and tackle, that make wine or make widgets or make food products or other things. The fact that he's being lured into this data center world, I think might be that negative indicator that the data center bubble is ready to pop. What do you think?
Maybe, could be. He is part of a bigger team looking for this investment. So I don't know, it could be the pivot point for it. Who knows? It's certainly worth watching. And he's such a big thinker, so saying we're not just going to build a data center, we're going to build the biggest one that the United States has ever seen and give China a run for their money. I mean, that gets a lot of attention, and certainly they're being aggressive in pushing this forward.
I'm going to go one step further. I'm going to call this the data center top right now. I'm going to say this is the shoeshine boy moment for data centers, when people who are tourists in this part of the space jump in to the pool with both, in cannonball fashion. I think that represents a top. I do want to give you one more headline that I saw on Zero Hedge. I'm a pretty loyal Zero Hedge follower. It's up there with CNBC and ESPN and a few other things that are in my short list of things that I'm checking every morning. This was a headline, and I'd love to get your thoughts on this. This was Goldman. They were quoting Goldman on this headline. Retail And by retail, they mean the retail buyer of stocks, people that are day traders, people that are buying lots of maybe 5 or 10,000 in stocks, that type of thing, dollars, that is, not shares. Retail has moved from buy the dip to trade the mania. And to me, that's another inflection point. If the day traders are out there trading the mania on SanDisk and Micron and AMD and others, I see that too as a point where it's time for a timeout. We're due for a step back, but I've been wrong probably as many times as I've been right. So we'll have to wait and see.
Yeah, that one is interesting. It's a pretty natural progression for when markets have already had a strong run, and certainly ours has. It's kind of a different kind of behavior where it doesn't necessarily mean a downturn is imminent. Sometimes a phase like that can extend a rally, but it certainly could be viewed as a sign that the market is becoming more fragile beneath the surface. And like you said, it's not a bad time for the market to kind of take a breath, and assess before things start to crumble.
I want to go back to your road trip, which last week extended to a second week. You have been traveling the country talking to environmental due diligence professionals and other CRE types. I think I asked this last week, but I want to get the vibe check again in week 2. War in Iran, 2 months old, risk premiums higher, Treasury rates higher, and yet the confidence is still there. And in the headlines we're seeing from Commercial Observer and The Real Deal, liquidity is still there. How do you size that up? And is anybody nervously laughing about, well, it's good for now, but let's see where we are in a month?
It's interesting. We were in Atlanta, we were in Charlotte, and we were in northern New Jersey. Now, admittedly, those are 3 really strong commercial real estate markets right now. So the environmental due diligence consultants in the room, they're working with what I've called kind of the tip of the sword. They're working with investors and they're working with lenders and doing the underwriting and due diligence that precedes loans and closing. So universally, all very busy, none hearing any chatter about their clients tapping the brakes. But they're very sensitive to the fact that their own pipelines can kind of ebb and flow. They saw that a lot more last year, but they were seeing more of a steady stream of projects in the first quarter than they did last year, meaning deals weren't kind of stopping and starting like they had been. And the other thing that they actually like is that when their clients are getting nervous and becoming more risk averse, that means if they deliver an environmental report that identifies a potential issue, maybe it's a dry cleaner next door, maybe it's a tank that's buried on the property, they're more likely to come back to their consultant and say, hey, let's shake the trees a little bit, let's do some added investigation, let's move forward with eyes wide open. So there's definitely caution and concern about what the second quarter might bring. But at least for now, what's been happening on the geopolitical front and the macro uncertainty doesn't seem to be affecting their sentiment at all.
Before we get into the data dive, I have to give that team, and you, because I consider you part of that team, a real shameless plug for the stuff that's been built. Not only there, the environmental group within EDR, the engineering team within LightBox, the product people, just really, really cutting edge stuff that's coming out. I wish I had a better word than stuff. Products, I guess, innovations, this ability that you can go back 100 years and now know, was there ever a gas station around this property that I'm thinking about buying? Was there ever a dry cleaner there? Is there a dry cleaner now? Watching that lineage, I think is such a game changer. And for me, looking over the horizon, and this is another shameless plug, I suppose, is that we can't wait, and it's going to come sooner rather than later, to start folding this into our capital markets data. Where are there loans on things that might be problematic? Where are problems brewing? And then also, where is all this phase 1 activity happening? What markets are hot? What markets are not? Where are phase 1s being done? And which is the next big area to explode in terms of new multifamily housing or new mixed use or new retail? So it's a great time. I call it internally. We haven't gone with this publicly, but it's really the Lightbox revolution. Internally, we use that term in terms of the things we're exploiting now to educate our clients, which is so much fun right now. And we're going to have our president, Eric Frank, on in a couple of weeks, and he's going to talk more about this. So I don't want to steal all his thunder, but it's a great time right now for what we're building. I'm going to play the role of Alyssa right now since she's out today. So let me read her line that normally goes in, which is, Let's turn to our LightBox data dive, Dianne. What are you watching this week?
Well done, Manus. Today's data dive is about the first stop on our roadshow tour next week. We're going to hit Chicago on Tuesday, the Windy City. Lightbox's data on the environmental side shows that it's the third largest market for phase ones in the U.S., behind New York and L.A. And Chicago, Manus, is experiencing phenomenal growth. Their volume of environmental due diligence was up by 24% last year and up by another 8% in Q1. And we should have a happy audience there on Tuesday because PricewaterhouseCoopers, which, if you know them, they do this fabulous report every year called Emerging Trends in Real Estate, where they rank metros in terms of prospects for the new year. Chicago jumped up 11 spots this year in the PricewaterhouseCoopers ranking. So look forward to seeing some happy clients in Chicago next week. And we have some lender clients there too from Wells Fargo and Fifth Third. So very interested to hear what they have to say about the market.
We have had some anecdotes recently about Chicago and the upper Midwest in general. We had Richard Hill on a few weeks ago, and he talked about the benefit of slow and boring in the upper Midwest, that they didn't have those go-go years of 2022 and 2021 where there was new building hand over fist like we saw in the Southeast and Southwest. So they're benefiting from the inventory not exploding over the last couple of years. And the other thing we're seeing is, at least in the Chicago suburbs, just real velocity and pricing improvement in the suburban Chicago multifamily market. So I guess I'm not really surprised by what you're saying right now, that there's been this anecdotal evidence in recent months, and now we're seeing the science behind it.
Yeah, exactly. And before we leave the topic, I want to let you know, Manus, that we have a very loyal CRE Weekly Digest fan in Atlanta. He came to our event. His name is Nathan Burnside, and he posted on LinkedIn just yesterday that he has mentioned our podcast to several regional bankers this week. Thank you so much, Nathan. He was at AEI Consultants for many years. He just moved out on his own with a new firm called Bedrock Compliance and Risk Services. So he will be supporting architecture and engineering firms, developers and lenders with things like contract review, like compliance advisory services. So Nathan, thanks to you for coming to our event. We appreciate the recommendation, and best of luck to you with your new venture.
Absolutely. Thank you for listening. And certainly I underscore what Dianne just said. Best of luck in this new venture. Anybody that goes out and starts something new, a great sign of faith and a big leap of faith. And anytime somebody takes that entrepreneurial next step, we root for them really, really hard. And while we're on the topic of Atlanta, I need to throw this one out. I was able to golf last week with a couple of listeners from Atlanta, Joel R. being one of them. He was one of my earliest listeners back in my Trep days in 2020 when we started out, and he and I try to golf once or twice a year and talk about the market. He brings along another listener, Dave, who we talk shop, and we have a great day and appreciate their listenership as well. And for this week's Did You Know, Dianne, what do you have?
My Did You Know for the week is that in Q1, the average views per property listing in our LightBox Live platform was 133 compared to only 118 2 years ago. I mentioned already, today's the last day of April. So Manus, I'm hoping we'll have at least a preliminary read on the April CRE activity index when I'm on the road next week.
I've said this many times. I'll say it again. This April number is very, very important to me. We've seen inflection points in the past. A year ago, after the tariff announcement came out, we were worried that the flow of activity in CRE might slow down. It never really did. We thought that maybe the war in Iran might do the same. This is the first real full month reading we'll see since the shooting began in the Middle East. And I do think that a strong number, a number that shows something equal to last month or only a very modest dip, would really underscore the point that you and I have been making for several months, that CRE is on the cusp of a real additional leg higher in terms of activity. If we see a bigger dip than that, I think what we're going to say is the war in Iran, higher oil prices, higher treasury rates are leaving a mark. So I'm really eager to see that number. I have to say that when I look at the transactions day after day after day, the sales transactions, I am seeing a slight downtick, right? Not a lot. It seems like maybe 5 to 7%. lower activity day over day, week over week than we're used to. And I would say where the activity is slowing is in those big deals, the 9-figure deals, 150 million, 200 million and up. And maybe that makes sense. Maybe when you're doing a deal like that and you have to line up a $100 million loan and the cost of that loan has gone up 75 basis points, maybe that takes the wind out of your sails a lot more than if you're looking to raise $10 million in debt. And so we'll see. We'll have our activity index next week, and I'm really eager to see it.
Yeah, it's a good point. And I'll be leaning on my data experts, Quinn Overson and Nathan Dever, to send those numbers over so that we can chat about it a week from today. But Manus, I know you're a betting man. So the index was 117 in March. It was 121 in February and 111 in January. Want to take a guess on how April might come in based on what you just said?
I'm going to say like a 112-ish, 113. I think we dip. I don't think we collapse, but I think that on the margin, we see slightly less activity than we've been seeing, and we can attribute it to the war and its follow-on effects of higher Treasury rates and higher oil prices.
Yeah, so maybe a little closer to January, but hopefully not back down to the double digits. If it got into the double digits, I would worry.
I would too.
All right, Manus, let's transition and start talking about some of the headlines on specific deals. Let's start with office. There's a lot happening there.
There really is, and we probably have, as we normally do, more stories across more segments and geographies that we could possibly get to. Our team here, we usually have 20 or 25 different stories that we could choose from, and we get to about 5 or 6 each week. So we'll get to some of these stories, but we will start with office, and let's jump right in. A couple real positive headlines. The first one coming from Dianne of CNBC. She puts out her property report every Tuesday, which talks about macro trends in the mostly commercial real estate market, although sometimes she talks about residential and home builders and so forth. Her headline this week, office demand rebounds to the highest level since COVID. In the first quarter of this year, new in-person and virtual office tours reached their highest level since 2020. She cites the VTS Office Demand Index. That's the first time I think that we've referred to that index before. We'll keep watching that one because that's an interesting one to follow. She notes that San Francisco and New York City were leading the office demand parade, but I thought this was interesting, Dianne. Los Angeles, which has really been heavily hit with value declines and an explosion in vacancy, also saw a double-digit increase in demand for space over the last quarter. And this comes from Commercial Observer, a piece written by Nackle. New York City's Class B and C office recovery is real and accelerating. So a couple of headlines there that at least in a couple of cities, the office problem getting a little bit less.
Yeah, they're great headlines, and it's such a turnaround from what we were talking about a few years ago. I will say that the Bob Nackle article kind of brought to mind something that Ryan Severino said when he was a guest on the podcast, and it was, at some point, the higher demand that the market's seeing in New York City for those big, shiny Class A office buildings, eventually they'll run out of supply. And then that demand will kind of work its way down to the Class B and C offices. And certainly if demand for those properties is starting to accelerate, as Bob mentioned, it kind of bears out that prediction that Ryan made. So good on Ryan. He's always pretty accurate with his forecasting. And to your point about LA, San Francisco, New York City, these are metros that are seeing return to office really turning around. To be able to say that office visits in these metro areas are almost back to where they were, or certainly at their highest level since before the pandemic, that's huge, and that's driving a lot of things that we're talking about here. Record high leasing for office space, single asset office sales were up in San Francisco by 40% year over year in Q1. And that's the strongest first quarter that metro has seen since 2020. Certainly a lot happening, and it's good news.
I'll give 2 more thoughts on this. One, another positive article here, which is similar to the first 2 we referred to. This by Christopher Neely of The Real Deal. San Francisco is the only U.S. gateway to eclipse pre-pandemic office demand. That's another positive sign that goes with our first 2. But I will offer this cautionary remark about the rest of the country, I do think still it's a tale of two markets, or tale of two, it's two different stories taking place here. I do think that you see rebounds that are real in New York, San Francisco, and now we could throw LA, I suppose, into that mix. But I do think that there are still markets really, really being left behind. Minneapolis, Portland, perhaps Philadelphia, you'd throw in there, Chicago, where there's been really negligible movement in terms of value rebound. And so nobody should take our comments about San Francisco and New York and extrapolate them to the rest of the country. We still have big problems in many U.S. cities that need to be worked out.
Yeah, that's an important point. The recovery's been very uneven, but it's the stories that you just mentioned that really kind of shine a light on New York City and San Francisco. But it's important to remember, we have a big country and a lot of metros, and some still have a ways to go before they get even close to COVID or pre-COVID levels.
To close out the office, I just want to throw in one headline. We missed it last week, or I should say we couldn't get to it last week. This is reporting from Banking Dive. I think this is the first time we've referred to that publication. And the reporter there, Gabrielle Salisbury, she reports that SMBC, which is Sumitomo Bank, is bringing 2,000 office jobs to Charlotte. They are making a $50 million investment into that area. And I would put Charlotte into the same category as some of those other cities that were hard hit. They saw the merger of SunTrust and BB&T lead to a real consolidation of space in that market. Wells Fargo dramatically reduced their footprint in that city. So did Bank of America. And so to see Sumitomo move in there with such a big number is a great headline for us. And maybe that's the start of Charlotte starting to see a rebound in its office market.
Yeah, hopefully. We held our event there last Wednesday, and we were in a tower right downtown in the Central Business District. We were on the 16th floor, so we had a nice vantage point to look around. And I saw a lot of cranes downtown, which I always think is a really good thing for a city. SMBC joins banks like Citi, which have a footprint there, US Bank. We were right next to the Truist Bank Tower, which of course was the result of the merger between SunTrust and BB&T. And one of our speakers was John Ryback, who heads up the environmental risk management group at Truist. And I think he said he's been in Charlotte for 30 years. And in those 30 years, it's probably grown 3 times. And certainly moves like this one will fuel that growth even more. So Charlotte, I think, is a pretty good place to be right now.
It's a nice city, I have to say. And its skyline has changed dramatically over the last 20 years. It's really gone from a small city to a big city, I guess you would say. It's really taken off, and it's become quite the banking hub in those 20 years. So
one article said that Charlotte is now the second largest banking hub in the U.S. after New York City.
And that may become even bigger. We saw those headlines this week. I think it was a tactical mistake by the new mayor, Mandami, to make the, how do you say it, pied-à-terre, right? The apartments that people take in New York City as second homes. He made the CEO of Citadel the poster child for people that pay for big apartments and are not paying enough in taxes. And it was a very personal attack. I don't think it was necessary. I don't think the personalization of the attack was necessary to announce the change in policy, but it does reinforce the nature that companies can move, and they've moved in big numbers from New York, first to Jersey City. They moved in big numbers to Texas, and they moved in big numbers to Charlotte. And if the business climate in New York gets hostile, we could see more of that, and it could accrue to Charlotte's benefit once again.
Mm-hmm. Absolutely. And a nice French pronunciation there, Manus. Did you take French in high school?
I took so much French. I took 4 years of French in high school, and I spent, 2 or 3 semesters in college, and I spent 3 months in France, and I still never really learned the language. It's just like, it's part of the brain that never developed for me, that I could barely tell, like, if somebody's speaking Spanish versus somebody speaking German, right? I couldn't even tell you what language they're speaking. That comes after years and years of trying. Why I tried so hard, I guess, I don't know. In college, it was a prerequisite, and in high school, I guess it was the same. But boy, I was like a right-handed person trying to write left-handed, right? It was just an impossible task for my professors.
I took French for 4 years, and I went about 10 years ago to Paris with some friends, and I was so humbled to realize that the only people I could understand speaking French were toddlers on the metro.
There you go. You and I are in the same boat. We should probably spend some time this week on multifamily because we've seen some recent earnings announcements which were encouraging. Some of them came out yesterday. So let's go through some multifamily. We have two stories on the earnings side and two on the sales side, which we can get to in short order. The first one, equity residential, they saw better than expected earnings. Their funds from operations per share were better than anticipated. Occupancy held steady. The reporting there from Tom Acitelli of Commercial Observer. The firm credited really strong results in New York City and San Francisco. There are those two cities again for their positive results, really firm pricing in those two cities to drive their earnings. Mr. Acitelli also reported that Avalon Bay saw really healthy Q1 earnings, their earnings again better than expected. In the case of Avalon Bay, they cited the fact that new inventory had kind of dried up. That new inventory that we saw in 2023 and 2024 has finally started to taper off. That gave them a little bit more pricing power, and that's a good sign. So maybe we'll see some multifamily buyers, owners, portfolio managers start to see some of that tailwind of rental growth that has been elusive for the last couple of years.
Yeah, I think so. And certainly multifamily is a sector where there's so much differentiation from metro to metro. But after a big construction boom and partly as the result of higher construction costs, fewer new units are coming online in a lot of metros. And of course, another big tailwind for multifamily is that people are staying renters for longer because buying a house is so expensive. So that's been a supportive setup for fundamentals. And I think anybody listening this week, Manus, who is not looking for investment properties in New York and San Francisco is probably thinking that they better start because certainly those are two very strong markets, not just in office, as we were just talking about, but in multifamily as well.
I will talk about two sales in this segment as well. I noted before that we hadn't seen a lot of 9-digit sales over the last couple of weeks. They had kind of tapered off. We had seen really in the industrial space, the office space, more of those $50 million sales than the mega ones. But we did see two big ones in multifamily. In Hollywood, out in California, Kilroy sold 2 apartment towers, one known as Columbia Square, the other on Vine, for over $200 million. Reporting there by Elena Botros of The Real Deal. And Berkshire Residential Investments, they're located in Boston, they paid $134 million for 299 units across 4 buildings in San Francisco. So the multifamily segment, even when things go down or slow down a little bit, that one never seems to slow down.
So we'll have to see when your tracker data comes in for April if we start seeing those 9-digit deals kind of ebb a little bit or continue to just move forward full force as they have been.
You've been traveling around the country. Business travel, not always the most fun. I'm not a big fan of business travel, but when you have to do it, I imagine you have some favorite cities in the U.S. that you like to visit. What are your favorite business travel cities across the U.S. if you have to get on a plane with a briefcase and a laptop to make a presentation?
Well, it is tiring and I do love it. And I've been fortunate to visit a lot of different cities, Manus. I will say that if you didn't limit it to the United States, I would have easily answered Vancouver because that really blew me away as an incredibly beautiful, well-planned city. But in the U.S., maybe it's because our news is very San Francisco heavy this week, but I would definitely put San Francisco at the top. Good food, natural beauty, it's on the water, cool architecture. And then on the secondary city side, I also really love Savannah and Nashville travel. So you got 4
That's
cities
great.
from me.
That's great. For me, it's San Diego. I love the fact that the airport is so in the city that you get off the airport and you're right there. Las Vegas is similar. I never have a bad thing to say about San Francisco, although I haven't been there since before COVID. Those are some of my favorite places. We've done your favorite places to go, but what is your favorite food within the airport? There's such slim pickings within an airport. Is it the dry croissant that's in the shrink wrap, or is it, the apple that's been sitting there for 4 days and is covered with dust.
Well, I'll mention one of our loyal listeners. I've mentioned him before, is Neil Chandler at Link Logistics. He literally told me once, Manus, that he will intentionally do connections through the Charlotte airport just so that he can get fried pickles from some barbecue stand in the atrium.
That's pretty funny. I find those airport food choices so modest that the only one I like in LaGuardia, I like the potbelly. If you've ever had that, where they make the pressed sandwiches, that can go for, but otherwise it's probably the croissant in the shrink wrap, sadly.
All right, we'll have to hit on that with a slice of life when Alyssa's back. Okay, well, thank you to our producers at Bruning Media. Be sure to join us each week as we break down the CRE news and data in context. You can listen on all your favorite podcast platforms and send your comments or questions to podcast@lightboxre.com. As always, thank you for listening. Have a great weekend.
Let's go.